we are ushering in 2019 with one of the most prominent voices that can analyze the global economy. Dr. Willem Buiter is chief economist, Citibank, but more importantly, in his previous avatars, Buiter has been member of the Monetary Policy Making Committee of the Bank of England. So he's a man who has worn many hats in the past. Dr. Buiter, thank you very much for joining us. We have to talk business, and let me start at the heart of the market sphere. Dr. Buiter, while the Fed may have said that it is reducing the number of rate hikes, the fear is that the Fed's balance sheet reduction is on autopilot, that it will reduce its balance sheet by the pre-decided amount. Is that a right, premise?
The Fed's balance sheet has never been an autopilot. The schedules that they produced just reflects their expected or their planned balance sheet contraction. If there are objective economic circumstances, such as a sudden tightening of financial conditions, that warrant an interruption or even a partial reversal of the balance sheet contraction, it will happen. They're not set in stone.
All right. Well, the Fed last time decreased its rate hike guidance for 2019, reduced it from 3 to 2. But what is your sense then? How many rate hikes are you factoring in? And as well, once again, to come back to the balance sheet issue, how different will be the balance sheet contraction, according to you, vis-a-vis the guidance of 50 billion per month?
Well, I think we're going to see a couple more hikes in rates, most likely in the US, probably later in the year, not March, but more like May or June. And I think we will, for the time being, continue to contract the balance sheet in this very gradual and measured way of 60 billion a month. The Fed will not change its course of action there unless there is visible evidence of faster than expected weakening of economic activity in the US, both current and prospective. And the Fed is, I think, somewhat more optimistic about US real economic prospects than the market, which accounts for the dichotomy in sentiment between what the market feels, which is fear and loathing, right, with the worst year in the stock market since 2008, and what the Fed seems to feel, which is an economy which, in terms of the real economic activity, unemployment and inflation objectives, is still broadly on target.
Okay, so now that'll be a bit of a worry if the Fed thinks the economy is doing better than the market thinks it's doing. Now, let me come to the other worry for financial markets, which is the tariff war. Do you think US and China will find common ground on tariffs before that 90-day deadline expires?
We really don't know what's going on. Yes, we had another, what was it, 4-hour or whatever telephone conversation between Xi Jinping and Donald Trump, but the meaning of that in terms of concrete progress in the trade negotiations is, I think, very unclear. And remember, these aren't pure trade negotiations. These aren't even trade plus tech plus intellectual property right negotiations. This is the new Cold War between a rising hegemon, an hegemon in the ascendant, which is China, and a hegemon in relative decline, which is the US. And that particular fight for global and regional dominance, preeminence, will be fought out in a range of arenas, not just the economic, no matter how broadly define it, but the diplomatic and potentially in different regions, even military. So there is a lot on the plate of Mr. Xi Jinping and Donald Trump that goes way beyond the normal trade negotiations that we've seen between the US and Canada and Mexico. Those were trade negotiations. Right? Between the US and China, this is global dominance negotiations.
Okay, I take that point. It's a Cold War. It's a new Cold War, as you put it, between the largest hegemon and the rising second largest hegemon. So, do you expect 2019 to be a year of, slowing growth, falling investments because of all these uncertainties on the trade front and other fronts?
Oh yes, definitely. This is our central projection. The global economy will slow down, driven by China and the US. The US because of domestic reasons, the unwinding of the fiscal stimulus, and China also because of domestic reasons, the unsustainable credit and debt boom and bubble that they have been using to drive the economy forward since 2008. And on top of that, we have the trade wars, and on top of that, we have the economic uncertainty created by the temporary suspension of part of the government in the US, plus uncertainty in Europe. No. There's no doubt that this will affect capital expenditure worldwide, and this will affect property values, and this will affect asset market valuations. So I don't think we've seen the worst of the stock markets yet, for instance.
Let me come to the other issue which has troubled financial markets. We have heard President Trump threatening to fire the Fed chairman, Jerome Powell. Do you think if the Fed persists with its rate hike calendar or balance sheet contraction, as you say it will, the president may actually fire Powell?
That is, I think, rather unlikely, because the president can fire the chair of the Fed only, as it's called, for cause. And cause is generally interpreted, although we have no precedent for this, as not excluding simply disagreements about policy. It might be possible, that is firing a governor. It might be possible for him to actually fire Powell as chair, but having to leave him as a governor, which would be a very strange situation, because of course the last rate decision by the Fed board and indeed by the FOMC was unanimous. So I don't think that Trump is going to go there, although you can never be completely sure. His propensity to do unexpected and rather over-the-top things is not to be underestimated. But I think that Powell's position looks safe to me.
Okay. Well, then that's another worry less, though it did send some jitters in financial markets in December. All right. Now, what does all your economic prognosis mean for financial investors? Where will smart money go in 2019? Given the slowdown you see in the US, do you think funds will rediscover emerging markets?
Well, a global slowdown is likely to occur during a period of still rising US policy rates and still quite high US longer-term yields. And I don't see any immediate weakening of the US dollar. So this doesn't sound like an external environment within which emerging markets thrive. Of course, oil prices are weak, and that helps a number of emerging markets, including India. But I think there is enough trouble through the capital account and through the trade accounts, trade conflict related broadly, as to offset the beneficial effect of any weakening of oil prices for countries like India.
Okay. Yeah, take your point. What we may get by way of lower crude prices may be taken away if there is a major foreign investor outflow. Okay, let me come to another issue. Since we spoke about Trump and Powell, our own former governor, Urjit Patel, resigned, ostensibly protesting the government interfering with his banking regulations and other rules. Now, is this a worry at all for foreign investors that a governor had to resign on principles?
Getting to a situation where the governor of the central bank feels he has no option but to resign to underline and emphasize and maintain as much as he can of the central bank's independence is not a good place to be. Right? It may have sort of short-term benefits in terms of more relaxed credit conditions, credit growth in the run-up to the elections in 2019, but clearly the country will pay a price for this undermining of central bank independence. Yes, that seems inevitable.
Oh, yes. Well, do you worry there will be more monetary and fiscal looseness because of this event and the new man in Min Street? And will this monetary and fiscal looseness result in some financial instability later in 2019 or in 2020?
Well, certainly for the next 5 months until the elections, right? I think we're going to have excessively loose fiscal policy and attempts to loosen monetary and credit policy as well. And I think a price will be paid for that after the elections. But since the period between now and the elections is a relatively short one, the damage that can be done, assuming that most of these handouts are going to be partially taken back following the elections, the damage need not be too serious.
Okay. Well, let's hope that way. Then my final question to you, 2019 is obviously important for us because of, the major election that we are getting into, the general elections. What's your sense about the Indian growth story? We seem to have kicked off a kind of a capex growth, but with this kind of a political economy backdrop, what's your sense of the India growth story?
Well, I think there should be a slowdown in Indian economic growth simply because of the worsening external environment. This can be offset to some extent by a greater fiscal stimulus and credit stimulus, but that would lead to a more unbalanced economy, a growing trade deficit and current account deficit, and I think a price to be paid through the currency and through capital outflows. So I see for India too a slowdown relative to 2018, and certainly a more unbalanced economy.
All right, that's not really pleasant to hear, but yes, I guess if there's fiscal and monetary looseness, the bill will have to be paid at some time. Dr. Buiter, it's a pleasure having you with us on the first day of the new year and delineating to us what you see by way of economic trends in the US, in the world, and in India. Here's wishing you once again a very, very happy 2019, yet again, from all of us in CNBC TV 18.
Thank you very much, and a very good New Year and Happy New Year to you and all people at CNBC India.
Well, that's not extremely positive by way of takeaways. The Fed might stay on course with its balance sheet contraction. US economy slows down a bit, but not slow enough for the Fed to change its balance sheet contraction. And third, global economy likely to slow down because power number 1 and power number 2 are at loggerheads. And finally, for India, the bill will come up for monetary and fiscal looseness, and that could create financial instability. We will also be affected by the global growth slowdown. Not extremely positive, but that's a reality check as we start 2018.